You might be wondering if you should be investing primarily to get some dividends or if you should be investing primarily for capital gains. Or perhaps you should be trying to get a combination of the both. Well, I'm here to set the record straight today. Today in this video, you're going to be learning about dividends, capital gains, any differences, similarities, and how they're taxed, and everything in between. Let's first talk about what are dividends and what are capital gains, just so we're all on the same page. So when it comes to dividends, dividends are basically a payment that's made from a company to its shareholders, okay? And that is the very basic definition of what a dividend actually is. And there are two primary kinds of dividends. So they can either be a qualified dividend or an unqualified dividend. And we'll talk a little bit more about that in just a minute. But let's move on to capital gains. So capital gains are basically the positive difference between what you buy an asset for and what you sell it for. So for example, if you bought an asset for $100 and you sold it for $110, the difference, which is a positive difference in this case, is known as a capital gain. So that $10 difference is your capital gain. And just like with dividends, there are two main primary types of capital gains. And those are going to be either short-term capital gains or they're going to be long-term capital gains. And we'll get to that in just a moment as well. When it comes to differentiating the difference between the dividends and the capital gains, one primary difference is the tax difference. Okay, so when it comes to dividends, you almost have no choice but to receive dividends. So basically, if a company says that they're going to pay a dividend to their shareholders and you happen to be a shareholder of that company, you are going to receive those dividends whenever they make those payments. Whereas with a capital gain, you can actually control when you realize that capital gain. So capital gains are unrealized until you actually sell the asset, and then it's known as a realized capital gain. So dividends, you can't really control when you receive them as long as you own the asset that is paying those dividends, but you can control when you are going to realize capital gains. So basically you can just hold off on selling your asset and realizing that capital gain for pretty much forever if you wanted to, as long as that asset still exists. And another difference between the two might be about their returns. So you might be wondering, what's going to give you higher returns, capital gains or dividends? And of course, that answer is going to depend on a variety of factors. But typically, capital gains are theoretically at least unlimited. So the amount that an asset can appreciate, the difference between what you bought it and what it could be worth in the future, theoretically that is going to be unlimited. There is no cap at how much a company, a stock, whatever it may be, an asset may be valued at. So theoretically capital gains are unlimited, whereas dividends are definitely capped. Dividends are going to be easier to see. Dividends are going to be easier to figure out how much you're going to get out of them. Typically companies that usually pay, historically always pay dividends, they're going to be somewhat close to what they've been paying in the past, so you can kind of get a look at a little bit more of a prediction. It's a little bit more predictable to receive those dividends in some cases. But usually when they are announced, this is how much we're going to pay as a dividends. Let's say it's 5%. It's going to be 5% of whatever their stock share is at that time. So you pretty much know exactly how much those dividends are going to be. Whereas you don't really know how much capital gains are going to be. And that means that typically more risk is going to be involved when you are going after capital gains rather than you're going for dividends. Because companies that are typically paying dividends are usually companies that are not growing as much. So it might be a very large, well-established company. Some sectors that might be a good example of this, something like in telecommunications or utilities. So these kinds of companies in these sectors, typically they are very large, they're well-established. There's not going to be very much other competition because they're so large, and it's really hard to get into that field. And so typically they are making their profit, and most of it is probably going to be expended out in the form of dividends to their shareholders. Whereas a smaller, like a tech company maybe, they will typically, investors are going to typically be looking for capital gains in those kinds of investments because they're looking for that company to expand, to get larger, and basically to become more valuable over time. So that is the difference between returns. Capital gains, typically they can be unlimited theoretically, whereas dividends are mostly going to be capped. They're going to be fixed, especially because when a company releases what their dividend is going to be, exactly how much you are going to get. And next we're going to talk about the tax consequences of both dividends and capital gains. But before I go there, really quick, if you're enjoying this video so far, make sure you like it and you give it a thumbs up. It really helps me out and I really do appreciate it. At the same time, consider subscribing to the channel and putting on that bell for notifications. Currently, I'm doing Tuesdays and Fridays at 8 a.m. Pacific Standard Time. So make sure you're subscribed and you have that bell on because you don't want to miss the new videos. Now let's move on to the tax consequences. So like I mentioned before, dividends can be either qualified or non-qualified, and I actually did a full video explaining the difference and how to get qualified versus unqualified dividends. So make sure you check out that video if you are interested. But other than that, the very quick synopsis of that is that qualified dividends are going to be taxed at the long-term capital gains rate, whereas non-qualified or unqualified dividends are going to be taxed at your individual tax rate. So typically, it's considered that qualified dividends are more desirable because of their tax consequences are a lot more desirable than being taxed at the individual income level. Typically, the long-term capital gains tax level is going to be more favorable pretty much for everyone. And that is the same thing when it comes to the capital gains. So when you're looking at short-term capital gains, those short-term capital gains are going to be taxed at your individual income tax rate, whereas if you have a long-term capital gain, that is going to be taxed at a special rate, which is known as the long-term capital gains rate. And that can be anywhere from 0%, 15%, 20%, in that order. So it's usually going to be less than what your actual individual income tax rate. And that's why long-term capital gains are more desirable, just as qualified dividends are going to be more desirable. And the difference between the long-term and the short-term when it comes to capital gain is just 1 year. So less than 1 year is going to be a short-term capital gain. More than 1 year that you held the asset is going to be a long-term capital gain. Now this brings us to one of the most important questions that we need to answer is, which is better? Are dividends better for higher returns, and having more predictable income? Are capital gains better for creating higher returns, even though they have more risk? What is going to be better? And the answer to that question is going to be highly individual. It's going to be highly dependent on your individual risk tolerance, what your goals are, what you are looking for in your investment. But overall, this is what I would say when it comes to determining which one is better. You need to look at growth and income, growth versus income. So when you're looking for capital gains, you are looking for growth in a company, for that company to expand, to become more valuable, and to become larger. Whereas when you're looking specifically for dividends, you're looking for companies that are going to produce income for you. So you need to determine what is going to be more important to you. Are you going after that growth, or are you going after that income? And of course, it's not like you have to go, completely far this way or completely far the other way. You can definitely have a combination of both, and that's what I do, and that's what I would definitely recommend for most individual investors. Whichever one you do end up picking, dividend, going after more primarily towards dividends or more primarily towards capital gains, you should definitely always have a long-term mindset. Don't go after the dividends just because they are giving you money now. I think that would be a bad strategy. But also, don't go after capital gains just because you're betting on a company to explode and become super large in a very small amount of time. Always try to think long-term when you're an individual investor, and that usually is going to yield really great results for you. Another thing that you should be focusing on as an individual investor is you should be focused on looking to buy assets that have low amounts of fees and can actually lower the amount of taxes you pay, or basically don't add to the amount of taxes that you already pay. So those are two definitely big things that you need to look for when you're deciding on what to invest in. That is going to be a big factor if you're deciding between dividends and capital gains, because you can control taxes a lot differently using both of them, and also depending on what kind of fund you are buying, whether it be an individual stock or a mutual fund or hopefully an index fund, you're always going to want to be looking for very low fees to keep more of your money and more of your gains in your own pocket. And lastly, always remember to diversify. One of the most important rules to investing, that is probably rule number one that you always learn, is make sure that you're investing. Make sure that you are diversifying when you are investing. So you shouldn't be going always towards 100% dividends, companies going towards dividends, and you shouldn't always be going 100% towards companies that are looking for high amounts of capital gain growth. You always want some kind of balance between the two, but you might be more geared towards the income side, you might be more geared towards the growth side. Whatever it may be, there is so much more to learn, and that is why this one video is not going to cut it. If you want to continue learning to become a better master of your cash flow, then make sure that you have watched this video that I created called How to Achieve Financial Independence in 10 Years or Less. It is a complete blueprint, a complete guide to becoming a master of your cash flow, becoming a better investor, a better saver, everything under the sun when it comes to personal finances. Thank you so much for watching this video. I'm Zach from OnCashflow.com, and I hope to see you next time.